Do you think financial crises are a recent phenomenon? What if I told you that the first major crisis in the United States happened back in 1792, just a few years after the country's founding? That's right, a true financial chaos caused by rampant speculation and a surprising lack of liquidity in the markets. The confidence people had in the economic system vanished overnight, leaving many in ruins. Want to know how this happened, and, more importantly, what we can learn from this extraordinary historical event? Stick around, because the lessons that emerge from this crisis are more relevant than ever. The creation of the first financial system in the U.S. In the late 18th century, the United States was rebuilding itself after the American Revolution, and it was necessary to establish a robust financial system. In this context, Alexander Hamilton stood out by presenting an innovative plan to create the Bank of the United States, which would be essential for organizing public finances. It was an extraordinary step for the young nation, but it also carried a great deal of responsibility. The curiosity was immense. Could a strong economy be built from scratch? By consolidating war debts and creating a unified currency, the country would finally have a solid financial foundation. However, no one imagined that this fragile structure would soon face one of the most critical moments in its history. Right after the founding of the bank, the markets began showing signs of excitement. Investors, thrilled with the new opportunities, quickly dove into buying stocks and bonds. The atmosphere was one of enthusiasm, and the idea of a unified financial market seemed like an intelligent solution for generating quick wealth. But behind this growing optimism, something deeper was about to be revealed. Collective euphoria often obscures warning signs, which are always unpredictable in the nature of markets. And this combination of factors set the stage for the first financial panic in the country. What many did not realize was that the financial system, however innovative, still lacked the protections necessary to prevent crises. In the rush to seize new opportunities, people forgot that the market doesn't forgive excesses. Liquidity shortages were already looming, with investors blinded by enthusiasm as speculation ran unchecked. It was incredible to think that in such a short time, such an influential system could become the epicenter of a crisis. Like a storm forming slowly, chaos in the financial market began to take shape unnoticed. As the market for bonds and stocks grew, so did speculation. And when we talk about speculation, we're referring to a phenomenon that isn't new in human history. The desire for quick, easy profit always piques curiosity, but it also tends to bring unexpected consequences. In the pursuit of wealth, investors exaggerated their bets, not realizing they were inflating the market unsustainably. This cycle of unchecked optimism always ends the same way. The market destabilizes and the first signs of a crisis start to emerge. The first signs of trouble were subtle, but they quickly took on extraordinary proportions. Investors realized that the value of stocks was far above what the assets were truly worth. This phenomenon, common in financial bubbles, occurs when market confidence becomes disconnected from economic reality. Hamilton, as influential and intelligent as he was, could not have predicted the speed at which panic would spread. In the blink of an eye, what had once seemed like a golden opportunity began to crumble, exposing the hidden fragilities within the newly created financial system. The lack of liquidity quickly became a major problem. When investors tried to sell their stocks and bonds, they found that there wasn't enough money circulating in the market to buy all these assets. Panic spread like wildfire, rapidly destroying the confidence that had been built. No one expected that the system created to stabilize the nation's finances would destabilize them so soon. And thus, the first major financial collapse in the United States became an undeniable reality, affecting thousands of investors and plunging the country into a deep crisis of confidence. The boom in speculation. With the U.S. financial system up and running, the market experienced a period of euphoria. The curiosity about the bright future that American finance promised attracted both seasoned and novice investors. Public debt bonds and stocks of newly created companies were bought in large volumes, and optimism was palpable. It was as if everyone was participating in something extraordinary, something that could change their lives. However, what few realized was that this frantic rush to buy assets was inflating prices to unrealistic levels. Everything seemed too incredible to be true, and, as often happens, that was exactly what was behind the growing financial bubble. In the nature of financial markets, enthusiasm often blinds people to risks. Speculation, a recurring phenomenon, overtook the American economy in 1792. People started buying bonds and stocks without worrying about the real value of these assets, believing that prices would continue to rise indefinitely. This behavior is both influential and contagious, because when everyone seems to be making money, it's hard to resist jumping into the game. And it was precisely this excessive confidence that set the stage for the impending collapse. The extraordinary rise in prices was fueled by a bubble that would inevitably burst sooner or later. The phenomenon of speculative bubbles wasn't new, but in 1792 it was particularly intense. Most investors lacked experience or a deep understanding of how markets worked, making them vulnerable to decisions driven by emotion. When asset prices rose, everyone wanted to join in, but the truth behind this apparent opportunity was far less glamorous. The value of assets didn't reflect the country's economic reality, but rather the investor's enthusiasm. The speculative behavior, historically, is the same we see in later crises, like the tulip mania in the Netherlands or the crash of 1929. It was a pattern repeating itself, and the U.S. market was about to learn this lesson the hard way. At the height of speculation, the profit seemed easy and fast, but this was just an illusion. Those with some market knowledge tried to warn of the dangers lurking ahead. However, most chose to ignore the warning signs and continued to invest, convinced that this extraordinary financial growth would never end. The pursuit of quick profit often blinds people, and this period was a clear example of that. In reality, what was happening was an artificial inflation of the market, where easy credit and exaggerated confidence created a vicious cycle of buying and selling without a solid foundation to support it. As speculation increased, the nature of markets showed its volatile face. The bigger issue was a lack of regulation and oversight. In a system still new, and without the proper tools to manage crises, volatility went from being a common phenomenon to a real threat. Investors were beginning to realize that the market was not as solid as it seemed, and this feeling of insecurity grew quietly. Slowly, confidence eroded, but publicly, the narrative was still one of optimism. This duality between public perception and the underlying reality is what often precedes major financial crises, and the panic of 1792 would be no exception. When investors finally began to realize that the prices of stocks and bonds wouldn't hold, it was as if the bubble had burst all at once. Sales started to accelerate and liquidity, or the lack thereof, became a central issue. Many investors were stuck with assets they couldn't sell, and when the first large-scale sell-offs happened, panic set in. The speculation that had been so profitable for some now turned into disaster for the majority. The market, like a living organism, was reacting with fear and despair, and the crisis was inevitable. The extraordinary boom that had begun with so much optimism and innovation came to a sudden and painful end. This was a moment when everyone realized that the unchecked pursuit of wealth isn't sustainable without a solid foundation. The panic that took hold of the markets in 1792 was a hard lesson, but a historical one. It showed that excessive speculation can quickly turn into despair, and that the financial market, however influential it may be, is still deeply vulnerable to irrational human behaviors. And thus, the collapse of 1792 became known as the first major financial crisis in the U.S., leaving lessons that resonate even today. The trigger of the crisis. In 1792, the U.S. financial market was already on the verge of collapse. The trigger of the crisis began subtly, almost imperceptibly. The first signs came from a growing distrust among some more experienced investors, who noticed that asset prices were far above their real value. It was an intriguing phenomenon. While the majority were still drunk on optimism, a small group began to question the solidity of this growth. With a lack of regulation and a very young market, These uncertainties quickly turned into fear. And like a match striking gunpowder, fear is the fastest catalyst for panic in financial markets. Panic spread with extraordinary speed, driven by the lack of liquidity in the market. At that time, the amount of money in circulation was limited, and the banking system still lacked modern mechanisms to manage crises. When investors tried to sell their assets en masse, they discovered that there weren't enough buyers, and the value of bonds and stocks began to plummet. This phenomenon is known as a liquidity run. It was as if everyone suddenly tried to squeeze through the same narrow door at the same time. This created a domino effect. The more people sold, the more prices fell, and the more prices fell, the greater the panic became. In this atmosphere of despair, influential figures in the market tried to intervene. A notable example was William Dewar, a former assistant to Alexander Hamilton, who had been heavily involved in the speculation of bonds. When the crisis began, Dewar, who had used loans to finance his purchases, was one of the first to fail to pay his debts. His bankruptcy was an extraordinary milestone in the crisis because he was a public figure of great influence. His fall further fueled fear among investors who wondered, if someone as powerful as Dewar could go bankrupt, who was safe? Human nature, always curious and driven by fear, began to question the stability of the system as a whole. As financial chaos took over, the crisis revealed the lack of preparedness of the government and financial institutions. The federal government had no structured plan to deal with a large-scale liquidity crisis. The banks, in turn, were few and didn't have enough capital to sustain the mass withdrawal demands. The lack of a safety net, something that seems so basic to us today, made the crisis even worse. This was a historic moment that highlighted the urgent need for a more regulated and resilient financial system. However, at that moment, the only thing investors could do was watch their wealth crumble. The extraordinary impact of the 1792 panic extended beyond Wall Street, affecting merchants and common workers. Many companies went bankrupt, and general confidence in the economy was deeply shaken. The crisis spread like a viral phenomenon, affecting both the financial elite and ordinary citizens, who faced unemployment and loss of income. It was a vicious cycle. The fall in stock prices led to business closures, which in turn reduced confidence in the market and further increased panic. The lesson that emerged was clear. Without a solid and regulated foundation, even the most innovative systems can quickly collapse. However, amid the chaos, there were attempts to contain the crisis. Alexander Hamilton himself, who had been the architect of the financial system, took extraordinary measures to stabilize the situation. He began injecting money into the market, buying government bonds to increase liquidity and restore confidence. It was a bold and innovative action that would later serve as the basis for modern government intervention policies in economic crises. Hamilton understood that, to prevent a larger catastrophe, the government needed to act as a last resort guarantor, which, in a way, marked the beginning of the understanding of the state's role in financial crises. Still, the 1792 panic went down in history as the first major financial crisis in the United States. It was an extraordinary phenomenon with lasting consequences. Although the market eventually recovered, the psychological impact of this crisis lingered for many years. It taught investors and policymakers that unchecked optimism and rampant speculation are dangerous traps. More than a financial crisis, it was a wake-up call about human nature and its impulses, which can be as influential in creating wealth as in destroying it. And so, the first chapter in the long history of financial crises in the U.S. was written, paving the way for future challenges and innovations in the global financial system. The immediate consequences of the crisis. After the financial collapse of 1792, the effects were devastating and rapid. The first immediate consequences were felt on Wall Street, where investors who had heavily bet on speculation lost fortunes in a matter of days. It was an extraordinary phenomenon to see how what seemed like an opportunity for quick wealth turned into a financial nightmare. Many of these people, driven by curiosity and greed, had invested everything they had, not foreseeing that the market could turn against them so quickly. Confidence in the newly created financial system was deeply shaken, and this created a domino effect, hitting economic sectors that relied on credit. With a drastic fall in stock and bond prices, market liquidity evaporated. The lack of money in circulation, already a problem before the crisis, became even worse. This meant that banks and businesses that relied on financing to operate closed their doors. The financial market, which had until then been seen as a source of innovation and growth, came to be viewed with distrust. Suddenly, the country was dealing with an extraordinary problem: the loss of confidence in the banking and financial system. This triggered a wave of bankruptcies, both of businesses and individuals who had borrowed to speculate. Amid this chaos, the impact of the crisis quickly spread to the real economy. Small merchants, artisans, and common workers felt the weight of the liquidity crisis. With many businesses going under, unemployment rose significantly, leaving entire families in precarious situations. It was a historic moment when the interconnection between the financial market and the daily economy became evident. The crisis showed that the collapse of Wall Street didn't just affect the rich and major investors. Its effects were felt at all levels of society. So, the extraordinary phenomenon that began as a speculative bubble turned into a social crisis. One of the most influential consequences of the 1792 crisis was the realization that the government needed to play a more active role in the economy. Until that point, the idea of state intervention was viewed with suspicion, but the panic changed this mentality. Alexander Hamilton, in an intelligent move, directly intervened in the market, buying bonds to restore liquidity. This was a historic action that showed the importance of extraordinary measures in times of crisis. The government, which had previously watched the market from a distance, was now forced to take more direct actions to stabilize the situation and restore confidence. However, even with Hamilton's intervention, the effects of the crisis were long-lasting. Confidence in the financial system wasn't restored overnight, and many investors remained hesitant to return to the market. Additionally, the economic impact continued to be felt for several years. Businesses that closed didn't reopen, and many workers who lost their jobs took time to find new opportunities. What became clear was that the crisis wasn't just a financial phenomenon. Its consequences reached deep into the country's social and economic fabric. It was the first time the United States experienced the harsh reality of a large-scale financial collapse. Despite all the difficulties, the 1792 crisis also brought important lessons. The government and investors learned that, however innovative and influential the market may be, it is always vulnerable to excesses and rampant speculation. The lack of regulation and the absence of a financial safety net were recognized as factors that contributed to the panic. This extraordinary crisis helped shape future thinking about how the financial system should work, planting the seeds for reforms that would come decades later. Although painful, this historical experience would be fundamental in developing a more solid and resilient financial system in the United States. Finally, the 1792 crisis became a milestone in the economic history of the United States. It showed how a financial crisis can quickly spread to the entire economy, affecting not just financial markets but also ordinary workers, businesses, and international trade. The crisis highlighted the importance of smart policies, quick interventions, and a diversified economy to withstand extraordinary shocks. The lessons learned from the economic impact of the panic were fundamental in shaping how the country would handle future crises, laying the groundwork for a more resilient economy better prepared to face the challenges to come. Alexander Hamilton's intervention. When financial panic gripped the country in 1792, the situation seemed out of control. In this critical moment, Alexander Hamilton, who had been the main architect of the American financial system, demonstrated his extraordinary ability to face crises. Hamilton knew that confidence in the market was fragile, and without quick and intelligent intervention, the economy could spiral into total collapse. The 1792 panic was the first major test for his economic policies, and he acted with an innovative vision that would later become a historic example of government intervention in times of crisis. His response was an important milestone in how the government would engage with financial markets in the future. Hamilton realized that the main cause of the panic was a lack of liquidity in the markets. With so many mass sell-offs, there wasn't enough money to support all transactions, which drove down bond and stock prices. So he took a bold step. He started buying government bonds, injecting money directly into the financial system. This action, now considered part of any response to economic crises, was innovative at the time. By doing so, Hamilton restored liquidity to the market and prevented asset prices from falling further. It was an extraordinary move that not only stabilized the economy, but also restored some of the confidence that had been destroyed. Hamilton's intervention was intelligent, but also risky. He knew that the government needed to act as a lender of last resort, a concept that would later become common in financial crises. At the time, however, this idea was revolutionary. Hamilton believed that the government couldn't be just a passive observer in the face of such a significant crisis. It needed to act, and act quickly. His action was seen as extraordinary but also controversial. Some critics feared that the government was interfering too much in the market, while others praised his courage and vision in preventing the crisis from worsening further. By injecting liquidity into the market, Hamilton wasn't just responding to the immediate crisis. He was planting the seeds of a new understanding of the government's role in the economy. Before the crisis, there was a strong belief that markets should operate freely without government interference. However, the 1792 experience showed that, in moments of panic, the absence of a regulatory hand could turn a small problem into a monumental disaster. Hamilton's intervention marked a historic turning point, influencing future economic policies that sought to balance market freedom with protective mechanisms. In addition to restoring liquidity, Hamilton also took steps to restore investor confidence. He worked directly with banks to ensure that loans continued to flow, preventing the financial crisis from turning into a banking crisis. This collaboration between the government and the private sector was an extraordinary example of how strategic coordination can save an economy. Hamilton knew that confidence was the most valuable resource during a financial crisis, and he did everything he could to maintain it. His efforts were crucial in preventing the panic from turning into a prolonged depression. Still, despite his successful intervention, Hamilton knew that the 1792 crisis would leave scars. Many investors and businesses were ruined, and full recovery would take time. However, the government's quick action prevented a total collapse of the financial system. Hamilton, always ahead of his time, understood that financial crises are part of the nature of markets, but that the response to them can determine a nation's future. His influential vision of an active government in times of crisis was a lasting legacy, shaping future policies for managing financial crises. The 1792 panic, despite its devastating consequences, was a historic moment of learning. Hamilton showed that government intervention is not only possible, but necessary in extraordinary times. His action paved the way for future economic policies, such as the establishment of the Federal Reserve more than a century later. By acting decisively, he proved that the government can play a crucial role in stabilizing markets and protecting the economy. This episode wasn't just a response to a momentary crisis, but a paradigm shift in the state's role in economic management. The impact on the banking system. After the panic of 1792, the American banking system was hit hard. The crisis exposed the extraordinary fragility and lack of structure within banks at the time, especially in such a young and unregulated market as the United States. Banks were still learning how to handle large volumes of transactions and, more importantly, how to manage the risks that came with rampant speculation. The lack of liquidity in the markets directly affected banks, which quickly found themselves without resources to meet the demands of their clients, resulting in a breakdown of trust between financial institutions and the public. One of the most serious problems was the inability of banks to meet the massive withdrawal requests. During the panic, many depositors rushed to withdraw their funds, fearing that banks would be unable to return their money. This phenomenon, known as a bank run, is one of the greatest fears of any financial institution, and in 1792, it became a historical reality. Many banks simply didn't have enough capital on hand to honor the withdrawals, forcing numerous institutions to shut down. It was an extraordinary blow to the American banking system, which had previously been seen as a pillar of security and economic stability. The crisis also highlighted the lack of regulation and oversight in the banking system. At the time, banks operated with little or no government supervision, allowing many institutions to make risky and reckless decisions. Without clear regulatory structures, the market was at the mercy of bankers and investors, who often used speculative practices to boost their profits. However, when the market turned, these same bankers didn't have enough reserves to cover their losses, resulting in the collapse of several banks. This extraordinary phenomenon revealed the urgent need for clear rules governing the operation of the financial system. Despite the devastating impact, the 1792 banking collapse brought important lessons. One of the most influential legacies of the crisis was the understanding that banks need sufficient reserves to weather periods of panic and liquidity crises. The lack of liquidity was one of the most critical factors that amplified the panic, as when customers lost confidence, there wasn't enough money to support them. This lesson would be applied decades later, when measures like mandatory reserve requirements and the creation of a central bank began to be debated and implemented. The banking system, although deeply affected, emerged from this crisis with a clearer understanding of its own limits and vulnerabilities. The government's response, led by Alexander Hamilton, was crucial in preventing an even greater catastrophe. In addition to buying bonds to inject liquidity into the market, Hamilton worked with banks to ensure they didn't close their doors completely. His intervention was extraordinary, as instead of allowing the banking system to disintegrate, he sought solutions to stabilize it. This action demonstrated that, although the banking system was fragile, it could still be saved with the appropriate government support. It was a historic moment that illustrated the interdependence between the private sector and the public sector, especially in times of crisis. However, full recovery of the banking system took time. Many banks never fully recovered, and those that survived learned the lesson of financial prudence. The 1792 crisis marked the beginning of a new era of caution for banks, which began adopting more conservative practices, at least temporarily. This extraordinary phenomenon showed that, in times of crisis, confidence is the most valuable asset of any financial institution. Without it, even the most solid banks can quickly crumble, as became evident to all involved in that panic. Finally, the 1792 crisis planted the seeds for future reforms in the banking system. Although these reforms didn't come immediately, the failures exposed during the panic were debated for years, paving the way for regulatory changes that would come much later. This historic episode showed that the banking system needs a strong and regulated structure to avoid chaos in times of uncertainty. The lessons learned from the 1792 panic were fundamental in shaping the future of the U.S. financial system, and their influential reverberations are still felt in how banks operate today. By injecting liquidity into the market, Hamilton wasn't just responding to the immediate crisis. He was planting the seeds of a new understanding of the government's role in the economy. Before the crisis, there was a strong belief that markets should operate freely without government interference. However, the 1792 experience showed that, in moments of panic, the absence of a regulatory hand could turn a small problem into a monumental disaster. Hamilton's intervention marked a historic turning point, influencing future economic policies that sought to balance market freedom with protective mechanisms. In addition to restoring liquidity, Hamilton also took steps to restore investor confidence. He worked directly with banks to ensure that loans continued to flow, preventing the financial crisis from turning into a banking crisis. This collaboration between the government and the private sector was an extraordinary example of how strategic coordination can save an economy. Hamilton knew that confidence was the most valuable resource during a financial crisis, and he did everything he could to maintain it. His efforts were crucial in preventing the panic from turning into a prolonged depression. Still, despite his successful intervention, Hamilton knew that the 1792 crisis would leave scars. Many investors and businesses were ruined, and full recovery would take time. However, the government's quick action prevented a total collapse of the financial system. Hamilton, always ahead of his time, understood that financial crises are part of the nature of markets, but that the response to them can determine a nation's future. His influential vision of an active government in times of crisis was a lasting legacy, shaping future policies for managing financial crises. The 1792 panic, despite its devastating consequences, was a historic moment of learning. Hamilton showed that government intervention is not only possible, but necessary in extraordinary times. His action paved the way for future economic policies, such as the establishment of the Federal Reserve more than a century later. By acting decisively, he proved that the government can play a crucial role in stabilizing markets and protecting the economy. This episode wasn't just a response to a momentary crisis, but a paradigm shift in the state's role in economic management. The impact on the banking system. After the panic of 1792, the American banking system was hit hard. The crisis exposed the extraordinary fragility and lack of structure within banks at the time, especially in such a young and unregulated market as the United States. Banks were still learning how to handle large volumes of transactions and, more importantly, how to manage the risks that came with rampant speculation. The lack of liquidity in the markets directly affected banks, which quickly found themselves without resources to meet the demands of their clients, resulting in a breakdown of trust between financial institutions and the public. One of the most serious problems was the inability of banks to meet the massive withdrawal requests. During the panic, many depositors rushed to withdraw their funds, fearing that banks would be unable to return their money. This phenomenon, known as a bank run, is one of the greatest fears of any financial institution, and in 1792, it became a historical reality. Many banks simply didn't have enough capital on hand to honor the withdrawals, forcing numerous institutions to shut down. It was an extraordinary blow to the American banking system, which had previously been seen as a pillar of security and economic stability. The crisis also highlighted the lack of regulation and oversight in the banking system. At the time, banks operated with little or no government supervision, allowing many institutions to make risky and reckless decisions. Without clear regulatory structures, the market was at the mercy of bankers and investors, who often used speculative practices to boost their profits. However, when the market turned, these same bankers didn't have enough reserves to cover their losses, resulting in the collapse of several banks. This extraordinary phenomenon revealed the urgent need for clear rules governing the operation of the financial system. Despite the devastating impact, the 1792 banking collapse brought important lessons. One of the most influential legacies of the crisis was the understanding that banks need sufficient reserves to weather periods of panic and liquidity crises. The lack of liquidity was one of the most critical factors that amplified the panic, as when customers lost confidence, there wasn't enough money to support them. This lesson would be applied decades later, when measures like mandatory reserve requirements and the creation of a central bank began to be debated and implemented. The banking system, although deeply affected, emerged from this crisis with a clearer understanding of its own limits and vulnerabilities. The government's response, led by Alexander Hamilton, was crucial in preventing an even greater catastrophe. In addition to buying bonds to inject liquidity into the market, Hamilton worked with banks to ensure they didn't close their doors completely. His intervention was extraordinary, as instead of allowing the banking system to disintegrate, he sought solutions to stabilize it. This action demonstrated that, although the banking system was fragile, it could still be saved with the appropriate government support. It was a historic moment that illustrated the interdependence between the private sector and the public sector, especially in times of crisis. However, full recovery of the banking system took time. Many banks never fully recovered, and those that survived learned the lesson of financial prudence. The 1792 crisis marked the beginning of a new era of caution for banks, which began adopting more conservative practices, at least temporarily. This extraordinary phenomenon showed that, in times of crisis, Confidence is the most valuable asset of any financial institution. Without it, even the most solid banks can quickly crumble, as became evident to all involved in that panic. Finally, the 1792 crisis planted the seeds for future reforms in the banking system. Although these reforms didn't come immediately, the failures exposed during the panic were debated for years, paving the way for regulatory changes that would come much later. This historic episode showed that the banking system needs a strong and regulated structure to avoid chaos in times of uncertainty. The lessons learned from the 1792 panic were fundamental in shaping the future of the U.S. financial system, and their influential reverberations are still felt in how banks operate today. The effect on investors and the market. The panic of 1792 had extraordinary consequences for investors, especially those who had been caught up in rampant speculation. Many investors, driven by the market's euphoria, had bet all their savings on the hope of quick profits. When the bubble burst, these same people saw their investments evaporate almost overnight. The optimism that had reigned in the market turned into fear and despair, leaving thousands of investors unsure of how to react. The phenomenon was even more devastating for small investors, who didn't have the financial reserves of large speculators to absorb the losses. This was the first major shock for the public regarding the risks of the financial market. One of the most significant impacts was the loss of trust. Until then, many believed that the stock and bond markets were an easy path to prosperity, without considering the risks involved. The crisis shattered this illusion, showing that the market can be as volatile as it is influential. Investors, driven by curiosity and the promise of extraordinary gains, discovered that speculation can be a double-edged sword. This collapse created widespread distrust, and many avoided the market for years, fearing they would lose even more money. This psychological effect was deep and lasting, shaping investor behavior for decades to come. Among the investors who lost everything, there were also those who acted more intelligently and managed to minimize their losses. Some, more cautious, were able to sell their assets before panic took over completely, saving part of their fortunes. This smaller group showed that the market is not just about luck, but about strategy and preparedness. The 1792 crisis highlighted the importance of being an informed and prudent investor who understands risks and knows how to react in turbulent times. Those who diversified their investments or maintained liquidity reserves were the ones least affected, an influential lesson for future investors. The financial market itself suffered a significant impact. After the collapse, liquidity almost completely disappeared, and confidence in the system took time to recover. Economic activity slowed, and trading volumes plummeted. The phenomenon of a frozen market, where no one buys or sells out of fear of what might happen, took hold. This market freeze created a long period of stagnation, during which investors hesitated to trade. It was as if everyone was waiting for clear signs of recovery before making any moves, a common effect in financial crises that we still see in similar events today. An interesting consequence of this period was the emergence of a new generation of more cautious and analytical investors. After watching so many lose fortunes, a smaller but more influential group began studying the market more deeply. This was one of the first times that investors started applying a more scientific and data-driven approach to making financial decisions. It was the beginning of a mindset shift, where intellectual curiosity and analysis replaced emotion and blind speculation. Although the market remained volatile, this group helped lay the foundation for more intelligent and calculated investment practices, which we would see develop throughout the 19th century. Even with Alexander Hamilton's intervention and the gradual stabilization of the market, investor recovery was slow. Many spent years rebuilding their finances, and some never managed to recover completely. This was a painful reminder that the market can be both a source of wealth and a source of ruin. The crisis also raised awareness about the importance of regulation and measures to protect investors. While these changes didn't happen immediately, the 1792 panic planted the seeds for future financial reforms, such as creating clearer rules to prevent speculative abuse. Finally, the impact on investors and the market wasn't just financial, but also psychological and cultural. The 1792 panic entered history as an extraordinary event that shaped how people viewed the stock market and the risks associated with it. It was a warning about the dangers of greed and lack of preparation, and a historical lesson on the need for a more intelligent and strategic approach to investing. At the same time, the crisis revealed that, however influential the financial market may be, it is vulnerable to human emotions and collective behaviors. The lessons learned from this episode continue to resonate in the world of investments today. The impact on the American economy. The 1792 financial panic didn't just affect financial markets and investors. Its extraordinary impact rippled throughout the entire American economy. The crisis caused a significant economic slowdown, affecting all productive sectors. The collapse of the financial market meant that many businesses lost access to credit, essential for maintaining their operations. Without this credit, several companies were forced to reduce their activities or close their doors, which led to a considerable increase in unemployment. This cascading effect hit merchants, artisans, and workers across the board, causing an economic contraction that took years to fully overcome. With many businesses closing, consumer confidence also plummeted. Families began to delay purchases and cut back on spending, fearing even more difficult times ahead. This behavior, while understandable, ended up worsening the crisis. When consumption drops drastically, the economy as a whole suffers because less money circulates through the system. This was one of the most evident phenomena during the 1792 panic. An economy that had been growing suddenly found itself paralyzed almost overnight. The extraordinary impact on consumption demonstrated the interconnection between financial markets and the real economy. The economic slowdown also hit agriculture, a crucial sector of the American economy at the time. Many farmers, who relied on credit to finance their crops, couldn't renew their loans due to the liquidity crisis in the banks. This resulted in a drop in agricultural production and rising food prices, further aggravating the economic situation. The phenomenon of the agricultural credit crisis showed how a liquidity shortage in one sector could spread throughout the economy, affecting everything from production to final consumption. Agriculture, which had previously seemed resilient, was another sector extraordinarily affected by the financial collapse. Additionally, the crisis had a direct impact on foreign trade. At the time, the United States depended on trade with other nations, especially Europe, to sustain its economy. However, the financial panic caused exports to drop sharply, as international markets also began to fear the risks associated with doing business with the Americans. The loss of confidence was an influential phenomenon in global trade and damaged the country's balance of payments. This forced the government to take extraordinary measures to try to stabilize trade relations and regain credibility in the international market, a process that would take time. The impact on tax revenue was also severe. With the economy contracting and businesses closing, the tax base shrank. Fewer operating businesses meant less revenue for the government, making it difficult to implement public policies for economic recovery. This scenario placed the government in a delicate position where it needed to intervene to save the economy, but lacked the resources to fund these actions. It was a historic lesson on the importance of a robust and diversified tax system, capable of withstanding severe economic shocks. However, despite the challenges, the 1792 panic also generated changes that, in the long run, would benefit the American economy. The crisis forced the government and business leaders to rethink their economic strategies, leading to a deeper debate on the need for financial market regulation and oversight. Additionally, Alexander Hamilton's intervention, injecting liquidity into the system, was an extraordinary milestone that helped mitigate the worst effects of the crisis and set a precedent for future government interventions. This episode showed that, although the economy was vulnerable, with appropriate measures, it was possible to avoid total collapse and ensure a gradual recovery. Finally, the 1792 panic became a milestone in the economic history of the United States. It showed how a financial crisis can quickly spread to the entire economy, affecting not only financial markets but also everyday workers, businesses, and international trade. The crisis highlighted the importance of intelligent policies, quick interventions, and a diversified economy to withstand extraordinary shocks. The lessons learned from the economic impact of the panic were fundamental in shaping how the country would handle future crises, laying the groundwork for a more resilient economy better prepared to face the challenges to come. The public and political reaction to the crisis. The financial panic of 1792 didn't just affect investors and businesses. It sparked a wave of public and political reaction that echoed throughout the young American nation. Ordinary people, who might not have paid much attention to financial markets before, suddenly felt the crisis's impact in their daily lives. Rising unemployment, business bankruptcies, and the scarcity of credit created an atmosphere of uncertainty and fear. For many, curiosity about how the financial system really worked gave way to widespread distrust. It was hard to understand how something seemingly so distant, like speculation on Wall Street, could have such extraordinary effects on their lives. The crisis prompted a quick, though not entirely coordinated, political response. Governors and local leaders, pressured by the economic hardships their communities faced, began calling for the federal government to take more decisive action. This moment was historic, as a more influential debate about the government's role in the economy began to emerge. Until then, there had been a widespread belief that government intervention in markets should be minimal. However, the 1792 panic brought a new reality to light. When left completely free, the market could collapse. This clash of beliefs sparked a political debate that would shape economic policies for decades to come. In Congress, the crisis led to heated discussions. Opponents of Alexander Hamilton, who had already criticized his financial policies, seized a moment to question the banking system and the centralization of national credit. The idea that the Bank of the United States had contributed to the speculative bubble began to gain traction among critics. This criticism was extraordinarily influential, as it planted the seeds of future political resistance to Hamilton's centralizing policies. The crisis fueled tensions between the Federalists, who supported Hamilton's model, and the Republicans, led by Thomas Jefferson, who advocated for a less government-involved market. Meanwhile, on the streets, popular discontent also began to grow. Merchants, farmers, and workers, who had once had confidence in the emerging economy, now questioned the financial system. The perception that the market was controlled by a wealthy and influential elite, who cared little about the consequences of their actions, began to spread. The crisis revealed a phenomenon that often recurs in financial crises. The division between rich and poor became even more apparent. This sense of social injustice increased pressure on the government to take measures that protected the most vulnerable, not just the big investors and banks. Interestingly, although Hamilton's intervention helped stabilize the market, it was also met with skepticism by both the public and the political class. Many saw the idea that the government should intervene directly in the market as something extraordinary and potentially dangerous. There was fear that this intervention could set a precedent for excessive state control over the economy, a debate that would continue for decades. However, this intervention also established an important precedent. In times of crisis, the government can and perhaps should act to protect the economy from total collapse. This dilemma between free markets and government intervention would remain a central issue in American politics. The crisis also led to the creation of new political and economic movements. Many groups began advocating for the regulation of financial markets, arguing that without clear rules, crises like the one in 1792 could happen again. These movements, though still nascent, laid the groundwork for future financial reforms. The idea that the government should create mechanisms of supervision and control over the market began to gain traction. It was an extraordinary shift in how the economy was viewed, which had until then been based on the belief that the market by nature was self-regulating. In the end, the public and political reaction to the 1792 panic was a defining moment in U.S. history. The crisis exposed the weaknesses of the financial system, but also paved the way for a crucial debate about the government's role in the economy and the need to protect society from the excesses of the market. Although the political response was fragmented and at times conflicting, the impact of this crisis would resonate for years, influencing economic policies and public perception of the financial market. The extraordinary lessons of this period would help shape the evolution of capitalism in the United States, establishing the foundations for a more regulated and, eventually, more stable financial system. The lessons learned from the Panic of 1792. The Panic of 1792 left extraordinary lessons that shaped the future of the United States financial system and even the world. One of the most important takeaways was the need for balance between innovation and caution in the market. The creation of the Bank of the United States and the consolidation of national debt were innovative steps, but unchecked enthusiasm for speculation showed how greed can quickly turn into disaster. For many, this crisis was a reminder that the financial market, however promising and influential it may be, requires regulation to prevent speculative behavior from spiraling out of control. From this event, it became clear that markets cannot operate in a regulatory vacuum. One of the main lessons was the importance of liquidity in the financial system. The lack of circulating money to cover transactions during panic revealed the need for mechanisms to ensure liquidity even in times of crisis. This phenomenon led to a reflection on creating more solid institutions with sufficient reserves to withstand future crises. Later, this idea would be crucial to the establishment of central banks, like the Federal Reserve, which today serves as a lender of last resort in times of crisis. The extraordinary impact of the liquidity shortage in 1792 served as a lasting warning about the importance of a well-structured financial system. Another important lesson that emerged from this crisis was the notion that the government has a fundamental role in stabilizing the economy during times of panic. Alexander Hamilton, with his direct intervention in the market, was a pioneer in showing that when the market fails, the government can and must act to restore confidence and prevent collapse. Although his intervention was criticized by some, it proved essential in containing the panic and preventing the crisis from deepening. This idea became an influential lesson for future economic policies, shaping how governments worldwide would respond to financial crises in the centuries to come. The 1792 crisis also taught that confidence in the financial system is an invaluable asset. The collapse of confidence that occurred when bond prices began to plummet demonstrated that without trust, even the most innovative and extraordinary systems can fail. Investors, businesses, and the general public need to believe that the market is stable and that its rules are clear and fair. The loss of confidence in the market was one of the factors that aggravated the panic, showing that restoring faith in the financial system must always be a priority during crises. This reinforced the importance of regulatory mechanisms that protect both the system and investors. Additionally, the crisis highlighted the interconnection between the financial market and the real economy. What started as a problem on Wall Street quickly spread to all sectors of the economy, affecting employment, production, and consumption. This was an important lesson in understanding that financial markets do not exist in isolation. Their fluctuations have extraordinary impacts on people's everyday lives. When the market collapses, it drags down businesses and jobs, and this reality became more apparent than ever in 1792. From this point on, it became clear that financial crises always have profound and long-lasting consequences for the real economy. A more subtle but equally important lesson was about investor behavior. The 1792 panic showed that the market is often driven by human emotions such as fear and greed. Investors who had been driven by curiosity and the promise of easy profits ended up paying the price when panic took hold. This served as a reminder that, however influential the financial market may be, it is extremely sensitive to human behavior and collective psychology. The crisis highlighted the need for financial education and a more strategic and informed approach to avoid the dangers of speculation. Finally, the Panic of 1792 was a historic event that taught the world that financial crises are inevitable, but that it is possible to mitigate their effects with swift actions intelligent planning, and a clear long-term vision. The lessons learned during this episode were extraordinarily valuable in developing more robust financial policies and institutions. They helped shape the evolution of the financial system, not only in the United States but globally, showing that economic stability depends on a combination of innovation, regulation, and strategic intervention when necessary. Now that you know the story behind the Panic of 1792, the question is, what will you do with this knowledge? Crises are inevitable, but preparation and smart action can minimize their impact. How are you planning to avoid falling into similar financial traps? Are you investing prudently or getting caught up in the excitement of the moment? If you want to ensure you're ready for the next economic challenge, apply these lessons and keep learning. Don't forget to subscribe to the channel and turn on notifications to stay updated on more incredible financial stories like this one.